Building on that, and especially in the context of rising crude prices and geopolitical developments, what are your thoughts on how oil supply disruptions and their possible impacts across economies?
Sure. So there are some who might believe that that question has no relevance anymore, Sonal, given the overnight developments. But I would say that, once you break something, it remains broken. It doesn't go back exactly to the same situation that used to occur prior to the break. So it's useful for us to showing us. And what you've got on the chart over here is essentially the oil flows from the Persian Gulf. The Persian Gulf is actually the biggest supplier of oil to the Asia Pac region. It is a very significant portion of the total supplies, and that has almost collapsed through the month of March and into early April. It roughly takes ships anywhere between about 30 to 45 days to complete its journey. So you can presume that the ships which left the Pacific Gulf prior to March have continued, the 1st of March, have continued to unload at their destinations over the last 30 days. But no ship has sailed in the last 30 days. And that is what you can see on the right side, that this is the duration of each oil tanker trip. And because those days have now sort of gone beyond that 30-day mark, there will be disruptions will show up in the month of April. Of course, journey time to the US is the longest, but to the Asian region, on average, the journey time could be 20-25 days. And then, of course, the entire turnaround time. So we do expect some impact of this disruption to show up simply because there will be less availability of oil and therefore less production numbers in the month of April. But we can also crunch this and look at it in different ways. If you just move to the next slide. Yeah. So whom does this tend to impact? You can see the data here for various emerging economies. Very simply, these economies on the left-hand side are the economies where, they are actually oil-producing economies. And therefore, as a result, it doesn't really matter to them that oil production has declined. But these economies on this side of the equation are the economies who actually import significant quantities of oil. And therefore, as a result of that, it tends to be negative for them. Now, when the oil shock took place in the mid 70s, the US was actually a net importer of oil. Of course, in this table, we are only discussing emerging markets. But at that point of time, remember, the US was the biggest importer of oil in the world. It actually is no longer an importer. It's the world's biggest exporter of oil. And it certainly doesn't receive any oil from the Persian Basin region. But simply put, higher oil prices and lack of supply is a problem in general for emerging economies. And of course, you can see where India figures within that position, not the worst impacted, but neither is it a net exporter. Every 10% rise in oil prices impacts GDP anywhere between a few basis points to 1%. Many of the economists who have published numbers for the current FY27 are estimating anywhere between 60 to 70 basis points of damage, because remember, oil is still about 40% higher than where it was. Remains disrupted till we can get back to normal, presuming that this ceasefire eventually is the real thing. But some more data to share with you, which you can see on the next slide. This again, I believe, is interesting. Yeah, Sonal, do I hand it back to you? Yeah, please.
Yeah. That was a helpful context, Vetri. Taking a step further and staying with the theme of oil and its broader implications, how do you see the current oil-driven shock playing across Asian economies, especially large net importers like China? And alongside that, how do you assess the potential impact on inflation?
Sure. So you can see that on the charts which are over here, which is why are the Asian countries more impacted by the conflict. You can see where India is positioned, which is to say that our stocks in terms of the number of days that we have to cover our demand is on the lower side, and at the same time, our oil imports from the Middle East less than the median, but still, it is not a insignificant amount. And then, of course, countries like Philippines, Vietnam, lot more impacted because they have less stock, and at the same time, significant portion of their imports come from the Middle East. Country like China, much better placed in terms of the stockpile that it has, more than 100 days of stockpiles. Korea, almost 200 days of supplies in terms of stockpiles. And China's dependence on the Middle East is very similar to that of India, which is about 40%. China, of course, is the biggest beneficiary of the Russia Ukraine conflict, in the sense that Russia started transporting a lot more of its oil to China via pipelines, and of course also by ship, but also significantly by pipelines. So they've actually de-risked themselves quite significantly from the Persian Basin. On the right side, you can see the energy trade for different countries. What is the energy trade balance as a percentage of GDP? So you can see that over here. Now, for Malaysia and Australia, because these are actually reasonably well balanced in terms of energy trade balance. So when we say energy, we now mean all sources of energy. Australia, in fact, has challenges in terms of its access to refined fuel. But when we talk about total energy, it includes things like coal, where they are surplus. When you look at a country like India, again, we are somewhere in the middle over there. 3%, minus 3% is our negative trade balance on account of energy. And of course, countries like Thailand and Philippines, lot more impacted in terms of their negative imports. So net, most Asian oil countries are net oil importers. They are dependent on the Middle East. Energy imports are very significant, and therefore they are likely to be significantly impacted. Good news in a relative context is that we are somewhere in the middle. Of course, we have pain, but neither are we insulated nor are we the worst impacted as far as this is concerned. We can also look at another context of this. I think, Sonal, we have one more slide. Yeah, there you go. And this is really looking at China. I already talked about the fact that China has been a little bit more better off when this crisis started. One, because remember, I showed you they have a lot more stock of oil which they have built up. More than 100 days of supplies is what they keep as stock with them. B, they have the pipelines which come in from Russia, that also has benefited them significantly. Also, their starting point in terms of inflation is quite comfortable. So their starting point, you can see here, actually the PPI is in negative territory, and CPI is barely above 0%. In fact, China's focus is how do we get CPI to go up. So there have been some economists suggesting that in a way China doesn't mind fuel prices going up because it will allow them to get CPI to go up. But I would argue that that is not necessarily a good outcome. An energy shock is not necessarily a good reason to set off positive inflation dynamics. But China, in a sense, a lot more insulated as compared to many Asian countries, including India. If we move on to the next slide, and I think this is an important slide, and in fact, those of you who are regular listeners to our podcast, to our conversation on the monthly market insight, will remember that I showed you this even last time to say that whenever there has been a military conflict, you can see various military conflicts which have been charted over here. This covers everything from Russia, Ukraine 2022, all the way to the second Gulf War 2003. And you can see in every case, the initial response is for a big hike in oil prices, and typically over a 4 to 5 month period, then the oil prices decline. And of course, 12 months later, the outcomes are very different. You could look at this 2003 and say, oh my God, oil prices did manage to go up a lot after the initial spike. But I would say that was also a function of the fact that the world saw a dramatic economic recovery at that point of time. But essentially, the bigger point is that the spike in prices eventually does resolve to the downside. Now we are 1 month into this. Prices are up almost about 40%, depending on what you count as the starting point. Presuming the ceasefire, we have holds. Oil prices may not go entirely back to their absolute starting point of about 60 $65 prior to this crisis, because some premium might get built into risk of disruption in the Persian Basin, and therefore, as a result, it could end up slightly higher, which is not unusual, but certainly they don't hold on to their 40-50% gains. So this is what we showed you last time. And so far, I would say with the price fall which has happened in the last few days, it is looking like some degree of normalization starting to set in. Fingers crossed, and let's hope that things stay on good keel. There is another way to look at the oil prices, and I think we have one more slide on that. Yeah, there you go. This is a slide which shows you what is the pricing of 1 month future, 3 month future, 6 month future, and 12-month future. So this blue line that you see here is the 1 month future. You can see that is trading at a massive premium to the 12-month future, right? So if you want to buy oil for current month delivery, it's $109. If you want to buy oil for 12-month delivery, it is $78. So that premium is nothing but the market estimating that we think over the next 12 months this problem will not be as significant as it is today, and therefore it is pricing the oil at a $30 discount 12 months out as compared to current prices. By the way, very interesting, this is the 1 month price, but if you actually look at physical deliveries, it is plus $20 at this point of time for physical delivery. So if you actually want physical delivery of oil today, it is even higher than the $109 that was prevailing yesterday. It would have actually been closer to $130. And some of the markets are extremely dislocated. For example, if you look at things like jet fuel, in Europe, the prices of jet fuel for physical delivery are even higher than the prices that used to be there in 2007 2008, when crude had hit $148 in the futures market. And that's a function of the refining deficit which is there at that point of time. But again, the bigger point in this chart is essentially this line at the bottom, which says that look, energy markets were anyway pricing that if you look at this over a 12-month period, we don't think the problem will persist, and which is why the market was in backwardation and you actually saw the future contracts trading at a discount.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.